Here at RVC, we conduct due diligence because it is important to investigate and evaluate business opportunities. Due diligence is all about looking for opportunities, providing mentorship, as well as keeping an eye out for risks. We look at deals because they seem promising, and sometimes we find problems that make them uninvestable, and other times we find bigger opportunities that the founders may not have noticed, making the investment opportunity even better. This chart shows that with just a median of 40 hours spent, the likelihood of receiving returns of less than $1 for each dollar invested goes down, and the likelihood of receiving exit multiples of 10 to 30 times or more increases dramatically. Overall, investors that perform a greater amount of due diligence receive 5 to 10 times greater returns than their lower diligence counterparts. In the production of its due diligence reports, RVC will conduct 1 to 200 hours of due diligence split between a team of analysts and angel investors. An advantage of investing in angel groups like RVC is that we have many members with sector expertise, so there is a wisdom of crowds effect with community engagement. Now sometimes, people mistake the due diligence process as mostly a mechanical and financial exercise, but there is an equal amount of intuitive work that should be done for due diligence as well. And in fact, analytical and intuitive work should be balanced throughout the process. On the analytical side, we take a look at key ratios, valuations, patents, research technology, as well as qualifications of a team and background checks. On the intuitive side, we assess how the deal feels overall, whether or not the team is being completely honest with us, and how well they will perform under adverse conditions. Due diligence starts from the very first contact that a potential investor has with the company all the way past funding. Even though a company may not be ready to pitch, initial meetings can tell an investor a lot about how a founder approaches problems, sets goals, and responds to criticism. These first impressions can also guide investors towards what they want to dig into during the formal due diligence process. After RVC has determined that a company has sufficient investor interest, they will move into our formal due diligence process. For the due diligence process to begin, a company must submit a minimum of 18 due diligence documents. Entrepreneurs are encouraged to submit more documents as it will help streamline the process further down the road. In the second phase of the process, investors meet with the leadership team to get their pressing questions answered. This step is essential to identifying the 2 to 4 key risks that a company must mitigate in order to be successful. In the next phase of the process, the lead investor meets with the venture capital analytics team and the RVC executive team. The venture capital analytics team is completely volunteer-based and is made of industry professionals including attorneys, CFAs, MBAs, and startup experts. The investors help to focus the team on the key risks and key strengths of a company. Starting at this meeting, the team will produce a fully fledged due diligence report in 21 days. This report can help the company syndicate with outside angel groups and individuals. Once the due diligence report has been completed, the lead investor and the RVC executive team negotiate a term sheet and track commitments. It is important to note that a company can follow at any point in this process, and consistent communication with the investors is key to helping get the round closed and is essential to raising future rounds. The speed at which a company goes through this process is directly correlated to how quickly the round closes. Here are a few tips to ensuring that this process goes smoothly. Have an organized due diligence folder. Respond promptly to inquiries from investors and the VCA team. Know what to expect from the due diligence process. Begin negotiations with outside investors early, and set a reasonable close date that keeps investors engaged but also takes into account that this process will take time. Due diligence is a process that is beneficial to both the investors and the entrepreneurs. Speed is extremely important. Make sure that you have your ducks in a row to ensure this process runs smoothly. If things run smoothly, this process can take as little as 4 hours per executive team member.